You guys are still bearish, and whenever anyone reads this fund manager survey at the moment, at least for the last couple of months, it looks really bearish. What's your takeaway? It's not bearish enough?
That's our take, is that it's not bearish enough to get you a big tradable low. Investors were absolutely bearish on macro this month, as they have been. They were bearish on markets. One of the big surprises this month is that they actually reduced their cash levels from 5.1% last month to 4.7% this month.
I was really surprised by this. Why?
Well, I mean, you would expect in a big market correction like we saw in October. By the way, 60-40 portfolio, conventional portfolio, saw its worst month in October since the financial crisis. You would think in that kind of a bad environment, investors would raise cash to get more defensive, but they actually deployed cash and they bought the correction. What's interesting is that they didn't buy aggressively, cyclically, kind of bullish. They were pretty defensive in the way that they bought. So you had big flows, big rotation out of tech into healthcare, into other defensive names.
The allocation to global tech has collapsed. I mean, put some numbers on that. What a collapse of an allocation to global tech actually means. What is that?
So this is the percent of investors saying that their overweight tech fell to the lowest level since February of 2009. It's a massive collapse. It's still actually the number 2 largest overweight in the survey. Just to give you a sense of the scale of how big an overweight tech has been. Number 1 now is healthcare. Note about that fact, the number 1, number 2 sectors are both growth assets. Yep. So investors are still willing to pay for visible earnings growth where they can get it, which is again a kind of a cautious stance on the market. Just
in terms of how incrementally bearish this survey is getting, there are many people out there that still believe the S&P 500 gets through 3,000 and then hits a peak somewhere there and thereabouts. That seems to be the base case, the average in this survey.
Right.
But then I look deeper into the survey. 1 in 3 think the top is in for this bull market, that we've seen the peak?
That's right. Absolutely. It's a kind of a weird moment for investors because they think that there's only 11% chance of a recession next year. They think that growth is going to slow down at the same time. They think that it's a good time to be deploying capital, but they want to deploy it in a defensive way. So it's a moment where investors are really concerned about the macro environment, concerned about earnings, but they don't want to get so defensive that they move into cash and bonds.
That's why I have a couple of things going on in this survey that I find difficult to square. The outlook for global growth seems to be very pessimistic. The outlook for corporate profits equally as pessimistic. The outlook for China, the worst in 2 years. Yet, if you look at the allocation to risk through 2019, the belief is that non-US outperforms. Where does that outperformance come from?
Well, look, I mean, I think for us, the big convergence trade is simply that one of 2 things needs to happen for U.S. and the rest of the world to converge in terms of equities next year. Either you need the Fed to pause, to give some kind of a dovish, soothing tone to markets, or you need China to stimulate in such a way that it boosts European exports, boosts growth globally. A lot of investors are baking that in. If we get clarity that neither of those 2 really positive things happen, then I think you get the full defensive capitulation.
Jared, final question, conviction call going into 2019 from you guys. Sounding bearish, not bearish enough in this survey apparently for you guys to get bullish. Where's the conviction trade on the bullish side of things? Where are you optimistic?
Our conviction is that markets don't start rallying until policymakers start panicking. When you have 11% recession odds, that's not enough for policymakers to start panicking. And until the Fed gives you a dovish tone, we don't think it's time to get long.